Hey, welcome to this video. Today I'm going to be reacting to Warren Buffett talking about how he would invest if he had to start again with $1 million. I've actually already seen this video from when I was doing research for my How to Invest Like Warren Buffett course, so it's more of a commentary at this point. And if you're interested in learning about how Warren Buffett used value investing to build long-term wealth, click my link in bio to sign up for a free preview. If you're new to my channel, please like and subscribe. My name is Charlie Money and I'm trying to create financial content to make investing more accessible to people. I also just started a Patreon account if you want to follow my market analysis in real time. Thanks for watching and let's get into the video.
Towards the end of 2018, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million. The question is, if tomorrow...
Starting off, CNBC is really pushing this clickbait because it's if you had to start again with $1 million, but his question was just if you had to start again with under $1 million, not $1 million.
If you had to start again with under $1 million. The question is, if tomorrow you woke up in the body of
your body.
20-year-old American.
Your body. But that's fine.
And your name was now Warren a la carte. And you had some money to invest on a full-time basis. What method or methods would you use to achieve that return? Would it involve flipping through 20,000 pages of Moody's manual or similar publications?
Yep.
Or finding, to find sticker butts? Or would it be hunting for great companies at a fair price as Mr. Munger would? Or would it be a combination of both with opportunity cost serving as the final arbiter of which method to use, given that your investing opportunity has now broadened significantly? Thank you.
Good question.
This guy actually started asking a great question, but then he leads into the answer. If your goal is to actually gain an insight into what Warren Buffett has to say, don't suggest multiple choices for him to choose from. Because this guy already wrote out an answer, Warren Buffett can piggyback off of them. As a result, I wonder how Warren Buffett's answer would have been different had this guy not extended his question for 3 minutes and multiple choices. Like, the question should have been a simple sentence. How would you invest if you were in your 20s and trying to achieve a 50% year-over-year return with less than $1 million? Done. Thank you.
I'm glad you came. And the answer would be, in my particular case, it would be going through the 20,000 pages. And
when he's talking about the 20,000 pages, they're referring to the Moody's manual 20,000 pages to look for investing ideas. The Moody's manual was a series of manuals published by the Moody Corporation, which is still around today, but they've stopped their physical publications in the 2000s. The equivalent today would be online databases like Moody's Analytics, Capital IQ, Bloomberg, and FactSet.
And since we were talking about railroads, I went through the Moody's Transportation Manual a couple of times. That was 1,500 or 2,000 pages, or probably 1,500 pages. And I found all kinds of interesting things when I was 50 or when I was...
This is the manual he's probably referring to, 1924 to 1951. Buffett started investing in the 1950s, so this is probably the one that he was using. The internet is great. You can get copies of these.
20 or 21, and I don't imagine there's anybody here that knows about the Green Bay and Western Railroad Company, but there were hundreds and hundreds of railroad companies, and I like to read about every one of them. The Green Bay and Western, in those days, everybody had a nickname for railroads. I mean, that was just what Northern Pacific was, the Nipper, and Phoebe Snow was one of them in the east that used to go up to Cornell, and the Green Bay and Western was known as grab baggage and walk, and GB&W.
So they probably used these types of mnemonic or catchy phrases for a couple of reasons. One, because a lot of communication back then happened on the phone. So it would have made it quicker to talk about companies, especially if the names are long and confusing, like Green Bay and Western Railroad. Green Bay and Western Railroad. It might also be a playful way to emphasize a characteristic about it. Grab, bag, agent, run. That sounds like you can make money and dip. I don't know if that's what that was intended to be. But then also, number 3, back then the tickers were fewer and shorter, sometimes like 1 or 2 letters only. So they were not as recognizable as today, like Microsoft or Apple, AAPL, MSFT. So it would have been helpful to avoid confusion to have these kind of mnemonic tickers.
And they had a bond that was actually the common stock, and they had a common stock that was actually a bond. And that could lead to unusual things, but they wouldn't lead to unusual things that would work for you with many millions of dollars. But if you collected a whole bunch of those, which I set out to do, and actually that's what impressed Charlie when I first met him, because I knew all the details of all these little companies on the West Coast that he thought I would never have heard of. But I knew about the Los Angeles Athletic Club or whatever it might be, and he thought he was the only one that knew about that, and that became an instant point of connection. So
here he's talking about a company that has a bond that was actually the common stock and a common stock that was actually the bond. And it's unusual because it could lead to mispricing and market inefficiencies. In his example, I could see it where a bond could have convertibility features into common stock and a high variable returns, which would make it act more like a stock, and a stock that would have high stable dividends but limited growth could act more like a bond. This is classic Buffett and Benjamin Graham investing, where they would exploit inefficiencies and anomalies by looking beyond the label of the security and assessing the intrinsic value. This could create opportunities for arbitrage, for example, because a bond's price could increase as the market realizes it offers equity-like upside, and the stock price could decrease while the market recognizes that it has limited growth and behaves more like a bond. Warren Buffett says this kind of works with smaller amounts of money, because if he did invest large amounts of money like he had today, pouring $500 million or $1 billion into one investment that small would completely flood that company. He's also talking about how him and Charlie shared that in common. Like, he was one of few that are actually looking this deeply into stocks, into the fundamental analysis, into the market discrepancies, into the market mispricing.
to answer your question, I don't know what the equivalent of Moody's manuals or anything would be now, but I would.
It's probably Moody's Analytics or Capital IQ or FactSet. If you're really curious, I actually found the manual that he was referring to, and you can see what kind of information he was looking at. So this is just going through some descriptions and financial statements of these companies. Here's the Green Bay and Western Railroad one. You can see we're looking at a P&L. There's a balance sheet down here, brief description of the capitalization structure.
Try and know everything about everything small, and I would find something, and with $1 million you could earn 50% a year, but you have to be in love with the subject.
Although small companies are riskier, Buffett says he would look for small things because small companies are often underfollowed by analysts and institutional investors, which creates more opportunities for mispricing and hidden opportunities. Smaller companies also have a higher growth potential because it's easier to double a relatively smaller amount of earnings and market cap than the more a company grows.
You can't just be in love with the money. You really got to just find it like essentially like, people find other things in other fields because they just love looking for it.
Because it takes so much work and research to succeed, you have to be dedicated and curious. What he's trying to say is that it's possible to achieve 50+% year-over-year annualized returns. You just have to be ready to put in the hard work and passionate about the research that you're doing.
Biologist looks for something because they want to find something. And that's built into. I don't know how the human brain works that much, and I don't think anybody understands too well how the human brain works. But there's different people that just find it exciting to expand their knowledge in a given area. I know great bridge players. I know great chess players. Actually, Kasparov came to Omaha and met Mrs. B. I've had the luck of meeting a lot of people that are unbelievably smart in their own arena and do some unbelievably dumb things in other areas. So
he compares it to a skill or a game, meaning that it doesn't have to do with intelligence, but how much time you put into it. Essentially, he's saying that even if you're not the smartest person, you can succeed in the stock market if you put in the time and effort and if you're passionate about it.
All I know is the human brain is complicated, but it does its best when you find out what your brain is really suited for, and then you just pound the hell out of it from that point. And that's what I would be doing if I had a small amount of money and I wanted to make 50% a year. But I also want.
He's going off a little bit and saying that you need to play to your strengths. Maybe not everyone would pick investing as their strength, but rather what their brain is best suited towards.
To just play the game. And you can't do it if you don't find the game of interest, whether it's bridge or whether, whatever it may be, chess, or in this case, finding securities that are undervalued. But it sounds to me like you're on the right track. I mean, anybody that'll come all the way to this annual meeting has got something in their mind other than bridge or chess.
That's nice. He's saying that guy must be onto something since he's coming to see Warren Buffett and talk and have the courage to go up and ask a question.
So I'm glad you came, and come again next year.
All right. Thanks for watching. Don't forget to like and subscribe. Let me know what you think and what you want me to react to next.